Hey everyone, and welcome back to the channel. You know that feeling when you hear about something super important happening in the news, like the RBI's latest monetary policy announcement, but you're not quite sure what it all means? It can feel like everyone else is speaking a different language. Well, don't worry, you're not alone. Today, we're diving deep into the world of central banking to break down the RBI's recent policy update, its goals, tools, and what it means for, well, you. Because even though it might seem like this stuff only matters to finance folks, the truth is, it impacts all of us. So buckle up, grab your metaphorical thinking caps, and let's decode the RBI's latest moves. Picture this. It's December 6th, 2024. The air is thick with anticipation as the Reserve Bank of India, the big kahuna of India's financial system, prepares to unveil its latest monetary policy. This isn't just any other policy announcement. It's a decision that sends ripples through the entire economy, influencing everything from the interest rates we pay on loans to the prices we see at the grocery store. This time around, the RBI decided to play it cool, keeping the repo rate steady at 6.5%. Now, you might be thinking, repo rate, what's that? Don't worry, we'll get to that in a bit. But the key takeaway here is that by holding the repo rate steady, the RBI is signaling its priority, keeping inflation in check while ensuring the economy continues to grow at a healthy pace. It's a delicate balancing act, kind of like trying to walk a tightrope while juggling flaming torches, but instead of torches, it's inflation and economic growth. Alright, let's break down the key takeaways from this policy update into bite-sized pieces, shall we? First up, we have the star of the show, the repo rate, holding strong at 6.5%. Remember we talked about the RBI trying to walk that tightrope between inflation and growth? Well, the repo rate is one of their main tools. It's the rate at which commercial banks borrow money from the RBI. By keeping it unchanged, the RBI is essentially saying, we're good for now, but we're keeping a close eye on things. Next up, the RBI decided to inject a little something into the economy by reducing the cash reserve ratio, or CRR, to 4%. This move frees up a whopping Rs 16 lakh crore, which is a whole lot of rupees, flowing directly into the banking system. Think of it like giving the economy a much-needed energy drink. We've been talking a lot about the RBI and its policies, but what exactly is the RBI's role in all of this? Well, imagine the Indian economy as a giant, complex machine with a lot of moving parts. The RBI is like the conductor, making sure all those parts work together in harmony. They're responsible for keeping the economy stable and preventing things from going haywire. One of their biggest jobs is to keep inflation, that pesky rise in prices, under control. Their target, to make sure inflation stays within a comfortable 4% plus or minus 2% band. Why? Because nobody likes it when their hard-earned money buys them less and less over time. But it's not just about inflation. The RBI also wants to see the economy grow, create jobs, and thrive. And to do that, they need to make sure there's enough money flowing through the system. So how does the RBI actually do all this? Well, they have this whole toolkit of monetary policy instruments, and it's way more interesting than it sounds, I promise. First, we've got the quantitative tools, the heavy hitters like the repo rate and the CRR, which we've already met. These are the tools that directly influence how much money is sloshing around in the economy. Then we have the qualitative tools, which are more about gentle nudges and subtle persuasion. Think of it like this. The quantitative tools are like adjusting the knobs and dials on a giant machine, while the qualitative tools are more like giving the machine a little pep talk to keep it running smoothly. Okay, so we've covered a lot of ground here, from repo rates to CRR cuts, but you might still be wondering, how does all of this affect me? Well, here's the thing. A stable economy, kept in check by a vigilant RBI, is good news for everyone. Remember that inflation we talked about? When the RBI does its job well, inflation stays in check, which means your money goes further. You can buy more groceries, clothes, or that new phone you've been eyeing without breaking the bank. To recap, the RBI's December policy focuses on steady rates liquidity boost and inflation management. How do you think this will affect you? Share your thoughts in the comments below. Thanks for watching. Don't forget to like and subscribe for more updates on the Indian economy and financial news.